I think an introduction is definitely in order. I've known Cliff for several years now as we've been working with the coalition. Met him at Eversheds Sutherland in New York at one of the events they hosted at their beautiful offices there just south of the park. But it was the first time I got to read through his resume. And I'll be honest, when I got it, it was like 6 pages. And I was like, come on, don't tell me 6 pages is all applicable. Holy cow. Cliff, you've done a lot. But the high points are he's a partner at Eversheds Sutherland. He advises, he got his start in the SEC, came out into the legal world. He's worked in private practice. He's worked at big firms. He really has seen all of the different viewpoints into securities regulations and compliance. His background is dense with a lot of very diverse activities. So not just, hey, big corporate lawyer in New York on the 40th floor. He's worked in smaller situations. He's worked on small groups. He's been a chair of one of the FINRA boards. Truly has seen all the different ways you can look at this industry from a legal and compliance perspective. He also teaches at the Wharton School, the FINRA Compliance Institute at the Wharton School, which, you know, I really do love when you have an academic element, because it is a nice ability to take a step back from the day-to-day job that you're down in the weeds, executing on things for clients, and take a broader view as to where are we going, how are we training the next generation to see the market and to see the compliance facet or angle of the market. So, you know, his involvement with both the educational and the absolute rubber meets the road practice, advising the largest firms in our industry on pooled investments, gives him truly a unique perspective that he can share with us. And with that, Cliff, I'm going to hand this over to you.
Great. Yeah, thanks for that. Thanks for that introduction, and your remarks were great. And it's a great day you have planned. It's a lot of great panel discussion. So we're looking forward to it. Very kind remarks. I appreciate it. I think the main reason I'm here is because I organized the coalition, but I should say there's a lot of folks who are on the line who are very active in the coalition, and they know this. I'm not just saying it. The coalition is very much a member-driven organization. So even our introduction to Delta Data, which we respect and we're looking to grow, that comes about because of a number of members who are on the phone brought that opportunity. So again, thanks to you, but also and thanks to the members who really drive the coalition. If we get to the next slide, Phil, you mentioned that a lot of folks are familiar to the coalition. I just wanted to speak for a couple of minutes to those who are, and just give them a little bit of an overview about the coalition. And I'll just take a couple of minutes on this, and then a couple of observations, and then hand it back to you. And I also thought if we talk a little bit about what we're doing, what we're thinking about, it'll play in nicely in terms of the great panels you have planned. There's a lot of what you're planning or active discussions that we have. So you mentioned the notes you're taking and the white paper. Yeah, I'll be taking notes, and also I'm going to be very interested to see the white paper, because I think there'll be takeaways for us also. So thanks for that. We were founded in 2012, and we now have about 50 member firms. So it's grown nicely. And those 50 member firms are investment managers, advisors, trust companies, service providers, all different shapes and sizes of participants in the collective trust fund marketplace. It's not a formal organization. It's not a formal corporate. It's not one firm has one vote. It's just, when a member firm joins, as many people at that firm who wants to be active in the coalition sign up for emails, committees, and the like. And again, it's a pretty robust, nice discussion, just a lot of group discussion. We have a number of committees, and a lot of what we do, a lot of the discussions are organized around committees. So we have an education and outreach committee that looks a lot at how could we be better communicating what CITs are, what they're not, how they work, how they operate to all different type of constituents, plan participants, plan sponsors, consultants. So, that's one thing we do. We have a legal and compliance committee that on a regular basis discusses different developments. A risk management and governance committee, and also a trust administration and client service committee. And I sort of have that one last, just to sort of highlight that trust administration and client service committee for purposes of this group, because that's where a lot of the interactions with Delta Data is through. So yeah, a lot of folks who are on that committee are here. And like I said, they brought this relationship to us. I know that they're excited, but yeah, it's through that committee that a lot of what you'll be speaking about today sort of translates to us. In terms of activities that we have regular calls, just regular meetings as developments happen. As I said, we have regular committee meetings. We send out a lot of emails just in terms of developments and uplike, and we also do a lot of benchmarking. A lot of benchmarking in terms of just common practices, where a member suggests something and then they, then we try to benchmark what the practices are. And we also publish a number of things. We have a white paper, a guide for plan participants. So we have a number of publications. Also, on an annual basis, we do a survey with Cerulli. We partner with Cerulli to get a better sense of industry trends and developments, challenges. And we also have a number of guest speakers, a number of guest speakers that we always tap into. And I say that here very thankfully to the OCC staff, who are always very, very kind to being guest speakers and collaborating, in terms of just sharing perspective on the industry. So, so that's sort of the coalition. On the next slide, I just wanted to give a couple of impressions because part of it, like a look ahead into the industry, but we're excited about how CITs are positioned. If you look at the retirement landscape, certainly mutual fund CITs, managed accounts and group annuities, and managed accounts, a lot of the variations of what we're seeing in managed accounts is where record keepers or somebody else is engaging or having an advisor platform where they enter into a relationship with a plan sponsor, but it's to help plan participants invest in mutual funds and CITs on the platform. It's an exciting time. In the industry. The one thing I would say that's changed considerably in the last 10 years is a lot of times we saw CITs are unregulated mutual funds. And
uh-oh, I think we might have lost Cliff. Kristen, can you confirm?
When you were doing the introduction, I knew the landscaper's time schedule, and I said, "Oh no, you're going to run into it." But that's it. So I apologize, but I hope you can hear okay now.
Yeah, we hear you now. Thank you.
Yeah, sorry about that. That always happens. It's unbelievable. Yeah, but
I was just reminding us that CITs. You're just reminding us CITs are unregulated mutual funds, right? That's what we all heard.
Yeah, and that was a lot of the focus in the past in terms of press reports, and that a lot of it formed the coalition. It was to try to get a better accounting of what CITs are and what they're not, and that's what led to a publication of a white paper that talked about the robust regulation of CITs, how they are regulated, and they're not just unregulated mutual funds. So, making that point. On the next slide, I want to talk about a couple of the trends. We talked about the growing presence of CITs and the growing acceptance and the growing understanding, and we're hoping to enhance that over the next over the next year with more publications as to what CITs are, and one that's particularly geared for the consultant world. So more on that this year, but that's one thing that we're planning to do. Transparency, you're having a whole panel on in terms of transparency. I'm looking forward to that with Devin McCarthy. But we've spoken to the folks at NASDAQ. They've been part of discussions with the coalitions in terms of how to increase transparency in the CIT industry. Another thing that we've seen is CITs coupled with annuity products. And also CITs coupled with more liquid investment. But that's a growing trend that we think we'll continue to see. And then the whole area of client servicing and trust administration. And I don't need to say much about that because that's why you're here today. How better to facilitate onboarding. And the type of things we've looked at over the past couple of years is, what type of documents do we require as an industry? What type of supporting documents are required? What sort of documents do we provide? But the whole reason why we're here today, at this Delta Data led initiative. But that's all done in terms of client servicing and trust administration. Whitfield, I was going to mention a couple of things we're looking at on the regulatory landscape, and then a couple of things looking ahead to 2021, and then hand it back to you. In terms of the regulatory landscape, and again, first and foremost, we understand, we appreciate, and we try to deal with the fact that CITs have a robust regulation about them. At the outset, they're a banking product, and they're regulated by banking regulators, and the OCC, are the primary regulators of bank collective trust funds. So we try to stay very, very, very much attuned to the OCC regulations, exam priorities, and the alike. You mentioned ERISA, Whitfield, in your opening. CITs are a plan asset vehicle. The underlying investments are considered to be plan assets. The fund trustee and the advisor are ERISA fiduciaries. So they have a very strong ERISA regulation component. They're exempt vehicles under the SEC, but to live within the exemption, they have to comply with certain things that I'll talk about in 30 seconds. And to the extent that they have derivative instruments and the like, they're CFTC regulated. So again, a robust structure. A couple of things that we've been looking at in the regulatory landscape. Number one, the SEC just made changes, and the coalition and others led an effort to sort of get this change, but to make it easier, and I won't get into the nuances, but to make it easier for collective investment trusts to satisfy the status to qualify as a qualified institutional buyer. So that's one thing where the SEC engaged in rulemaking at the coalition's pressing and others, the ABA. And that's a rule change that's going to go into effect in just a couple of weeks. So that's a nice development. We're looking also and thinking about the DOL's letter that allows CITs that are that are organized as target date funds to have greater flexibility to invest in private funds. And then another thing we're looking at, I'm going to mention it a little bit more, and because I know that Gail is leading a panel on sub-advisory oversight later on, so it sort of plays into that. But the whole focus on bank maintain, that grows out of the SEC exemptions that CITs live under. And to be a bank maintained collective investment trust, the bank has to have investment discretion. And the reason why this is important is we have a sense that this is going to be something that the SEC and other regulators look at over the next year or so. And the reason why is there was an enforcement action brought just in the last couple of weeks where the SEC sort of tested, well, was the entity in question, was it bank maintained? And it's an area where there's no real like updated guidance from the SEC end of things. The OCC does have guidance that's looked to, and we've been working toward. but there's a lot of effort, and Gail, I know in her panel is going to talk about it, in terms of the type of oversight and management that's needed to just have general good governance practices, but also to satisfy bank maintain from both the OCC and SEC perspective. So that's something in terms of the regulatory landscape. And as we look ahead, and the last slide, I'm going to take 30 more seconds with Phil, and then I'm going to hand it back to you. One thing that we have very much an eye on is 403B plan investments in CITs. Because of current restrictions in the securities laws, mostly the securities laws, 403B plans, which represents a huge marketplace, they're not able to invest in CITs. There's legislation that's pending, and obviously Congress, everything's in flux, as we go through the transition. But the key thing is it has wide support, and we expect it to have wide support next year when the new Congress is in place. That would allow 403B plans to invest in CITs, and that'll be a huge opportunities for CITs. The other thing we're looking at is so I should say we do expect to see something along those lines in 2021. The other thing in terms of what's ahead for us in 2021, republication of certain white papers that we've done, a plan, a reach out to plan consultants and the like. And then I'll leave it back to you. But one thing that's also ahead in 2021, we look forward to working with you on this initiative. So, with that, Whitfield, I'm going to turn it back to you. And again, sorry for that background noise, but hope you got some of that at least.
Oh no, we got it all. And in the current work from home, I'm working from my house too. That is the new par for the course, right?
Yeah. Whitfield, you mentioned the 40th floor, and as you were mentioning that in terms of my introduction, I said, "Man, it's been a long time since I've been there. I miss it." Yeah, and yeah.
I've actually I planned for this event by finding a way to get all four of my boys out of the house for most of the day. So I was just like, y'all are going on a field trip. But anyway, no, this is really interesting. And I think, thanks for the industry perspective, Cliff. But I think what you just alluded to is on all fronts, we are removing the barriers to entry for more people to participate in these securities. And if the 403B market does open up, let's stop kidding ourselves that this was just a 2 or 3 year growth spurt. These things are going to grow by volume and by assets for the next decade at least this pace, if not faster. These types of big movements in securities legislation are what will enable more participants in the market, in the institutional market, to invest, and that will drive further growth, even above and beyond the growth we've seen to date. And it's really interesting that they're paying attention in Washington to get more people better access. Interestingly, when people ask me what do I do, a lot of times I'll talk about CITs. We do a lot of things at Delta Data, but probably the best thing that I like talking about is the CIT world, because it's homogenous fiduciary responsibility. All the participants are fiduciaries to plans, and it helps people with retirement. It's in my opinion, one of the best facets of our industry is when people are laser focused on the best outcomes for the people investing. And CITs are at one of the best products that we've got as an industry. So Cliff, really appreciate what the coalition's doing to broaden the access to these securities and to work through, I'm not going to call it gray area, but any barriers to entry whereby legal counsel is like, there's some gray area in here. We're not 100% sure if we are a fiduciary or we aren't. It's good to just know black and white, work through the issues, work through the gray area. Everybody knows who's responsible for what, so that we can really focus on growth and getting as many Americans into this system, because the chassis is a great chassis for their life savings. So can't thank you enough for the work you're doing there. And again, that's That's the runway out in front of us opening up. The volume is going to continue to push on the middle and the back office to execute. And I think that's where this group is more focused is, okay, if we are able to survive and stay head above water on the growth we've seen over the last 3 or 4 years, let's really stop treading water and start swimming in a certain direction. If we tread water long enough, we're going to either quit or drown. So hopefully today we say, here's the direction we want to swim in. It's not, this is the exact dock we want to end up at, but let's stop treading water in the middle of the river and go to the side and get out. It's kind of how I look at this. So anyway, the other thing I wanted to just hit on that we were talking about a little earlier is why is this more difficult than other things that we've done? And I think it kind of boils down to 3 things that will be a recurring theme in today's topics. First off, there's a star model of communication. We are used to, as an industry, an advisor and a sub-advisor, or a dealer, intermediary, and an asset manager, or a bank trust and a fiduciary, or an institutional client and its bank trust. The point is that this is different in the fact that you have a sub-advisor, a bank trust, a retirement record keeper, a consultant, and perhaps an introducing dealer, all needing transparency into a single security. That exacerbates the issue that these securities are hard to find in common data sources. So we have a unique problem that we have to solve as an industry, in that we are much more accustomed to one-to-one communication channels. One party is sending information to a second party, that party is sending information back. And that one-to-one is pretty straightforward. When you get into the star model with multiple constituents, with different constituents on each piece of business sold, that's where the complexity comes in, that our teams and the way we've designed software for the last 30 years is having a bit of a struggle with. I was talking through a large dealer's kind of structure and where they're getting data from, but I thought what was interesting was, for each plan that was sold, it could be a slightly different model of who they're communicating with and who they're getting data from, and the frequency that data comes in, let alone the format's different. So what we have to do is, like any complex problem, like any math problem that you try and tackle, right now we're dealing with all these variables. Hopefully in today's meeting, we start turning certain variables that we are pretty sure we know the answer to into constants. And by turning enough of the variables into constants, we can focus back on the really difficult variables and start coming up with a solution plan to tackle those. It's not going to happen next week, but if over the course of the next quarter or two, we can say, okay, the basics around sharing of plan information, sharing of NAVs, and the transparency around attestation on eligibility, those, we know what the problem is, we know how to solve it, and we know what data sources and capabilities the industry has that can solve those problems. Let's go ahead and turn some of these variables into constants so the math problem doesn't look so very difficult to solve. Once we get down to the hardest components, if that's what's left, then it should be pretty straightforward to solve those pieces. So that's one point. The star communication diagram is difficult to solve for. The second is something that kind of dawned on me the other day. We as an industry haven't had to solve a problem like this in at least a decade. And what I mean by that is, many on the call, don't mean to date us all, were around when mutual funds went from being fax trades and dealing with these same transparency problems into a straight through process service. And the DTCC, a lot of the services made that, networking really kind of opened that up. That's been 20 something years ago. The closest problem like this that we've solved recently was private funds. I know in my history, when I was at Lehman, I did a lot of work around private equity investments and hedge fund investments by private, ultra high net worth and institutional clients. That's 15 years ago. It's been a while since we've seen this problem. We all know the problem. It has all the hallmarks that we've seen before: lack of transparency, lack of supported services, slightly different nuances than the last time we solved a set of these problems. But it has been a while since we really rolled our sleeves up and moved a major product to a straight through processing environment, not just within our shop, but amongst the industry participants, which gets into in my third point of what I think we have to solve for is we can't do this on our own. When we solved the mutual fund problem, and I'm calling the mutual fund problem, growth was exploding in the late 80s, early 90s. Faxes were flying around everywhere. I remember asking my first day at a broker dealer, what are all those fax machines? Like hundreds of them. It was ridiculous. When we solved that problem, it was still the one-to-one. We only had to solve networking with one fund at any given time. Yes, we send out a networking file with thousands of trades across hundreds of fund partners. It's still a one-to-one communication. So what we have to solve for right now is the shared responsibility in that STAR model. So we have to get to where we exchange data like we do for mutual funds. But what's much more difficult is sharing between 3 or 4 counterparties at the right cadence, with the right format, with the right expectation. But I assure you, we can't do it alone. I know there's 2 firms on this call that have built major technology platforms in-house. And I would still, even though they look really slick, I've seen a bit of some of them, they're still point solutions. As soon as the data hits the wall of that firm, it goes manual. So no matter how interesting the technology that any one of us can build, or we build for one of our clients, it is really hamstrung if it only works within the 4 walls of one firm. The synergy that is gained by straight through processing will only come with us working with each other in the industry and leaning on each other to share data in a seamless, frictionless environment. And with the STAR model versus the one-to-one model, it just can't be solved on your own. I'll use one analogy to illustrate that. One of the things Delta Data does is we build and deliver omnibus trading systems. Several of our clients don't trade via the DTCC for specific relationships, because in the 90s, the volume with those relationships got so big that they have their own, proprietary communication between a top 5 fund firm and a top 5 dealer. And that technology still exists today. It still doesn't flow through the DTCC. My point being is that is a bespoke one-off solution that they paid major money for that does one thing. It talks with one firm and responds back to requests from that one firm. In this STAR model, that doesn't help. Talking with only one firm, say talking with the bank trust as an introducing dealer, does not get you all the information you need. You have to talk to the retirement plan record keeper who is actually trading the fund and has plan information that you need. So given the complexities of the STAR model that we're working within, our traditional fallback go-to method of building bespoke in-house technology solutions, it just won't get us where we need to go, because we have to rely on our partners as much as we have to rely on our internal teams or our internal vendors to solve this problem. And I think that's the challenge of why we've been talking about this with, you know, documented research and prioritized actionable lists. Why we've been talking about this for 3 years and not seeing more traction is because this is a new model for us to solve for. This new model, we have to rely on our partners as much as we have to rely on our internal teams to be successful in the achievement of our long-term goals. So that being said, I think we're going to take a quick break. Is that correct, Kristen?
That's correct. We'll have a quick break and return at 10:50 for the NASDAQ session.
Great. Thanks for y'all's time on these opening remarks. Cliff, I can't thank you enough for participating through the years with us and providing, you know, your ongoing ear to our questions, as well as the work you're doing with the coalition in Washington to get as many Americans into this great product we have, which is truly, in my opinion, the best facet of what the financial industry provides to the American savers. All right, we'll take a break.